3 of 5 AI survivor stocks. My own methodology said sell. Here are all 5, and the 2 I still hold. I'm John Gillespie. I built OCCAM'S forensic jury, 4 independent analytical lenses run on any public ticker. Today, 5 names tied to the AI build-out. 2 I hold long, 3 I do not. I'm not telling you to buy these. I'm showing you what the methodology I built surfaced today, including the 3 names where it told me to wait. 2 I hold. The methodology says hold on both. That can look like confirmation bias. The same methodology flagged OBDC 2 weeks before its dividend cut against my long position. Track record on disagreement is on the public record. The thesis is one line. Cash flow that exists before AI, accelerates with AI, and survives without AI. That rules out a lot of the AI trade. Chip designers, the hyperscalers, the model labs, these are bets the AI build-out itself plays out the way the headlines say. The Outlast thesis is the opposite. It's the cash engine that was already running before any of this and gets bigger if the build out happens and keeps paying if it doesn't. We have 3 buckets: power generation and its fuel, the pipes that move the fuel, the metals the whole build out needs. 5 names across those 3 buckets. And here's the part most stock videos skip. The methodology I run does not agree with my thesis on 3 of the 5. Watch what the disagreement looks like. Stock 1 is EPD, that's Enterprise Product Partners, the boring income compounder. 25 years of fee-based take-or-pay pipeline distribution growth. Distribution coverage about 1.6 times, meaning the cash flow is 1.5 times what's needed to pay the distribution. Investment-grade balance sheet. AI data center gas demand is gravy on the business that's already over-covering its payout. The methodology run today shows EPD at a slight premium, margin of safety negative 9%, DCF intrinsic value of $36.50, while the current price is around $39.92. The verdict is a hold at medium confidence. Here's what the 4 lenses split on EPD. The auditor flagged the entry price premium. The architect read the 1.6 times coverage as structurally sound, and 2 of the 4 called it a wait for better price. None of the 4 called it broken. I owned it for years. The methodology is telling me the entry isn't a bargain at today's price. It's not telling me the business is broken. The cash engine is doing exactly what it was built to do. Now we're down to ET, the second stock of the list, Energy Transfer, the largest integrated U.S. pipeline network and the place where the AI build-out cash flow is most direct. ET just inked direct natural gas pipeline supply deals to AI data centers. The pipes were already there. The customer just changed. The methodology run shows margin of safety positive 8%. DCF's intrinsic value is $22.25. The market price is around $20.43. The verdict is a hold at medium confidence. Here's what the lenses split. The architect surfaced the leverage as a risk factor. The storyteller surfaced the AI data center contract wins as the offsetting trajectory. 2 lenses, 2 views of the same balance sheet. ET's debt to EBITDA ratio is north of 5. That looks over-levered if you read the ratio cold. But EBITDA in the denominator is growing faster than debt in the numerator. The ratio compresses without paying down a dollar. That's the textbook midstream deleveraging through growth pattern, and its trajectory is the methodology snapshot doesn't show. I've held ET for years and I haven't trimmed it a bit. Stock 3 is CCJ, Cameco, the uranium fuel name. Every running reactor and every restart locks in multi-year uranium supply contracts. The fuel demand outlasts whatever the AI narrative does to headlines. That's the thesis. Here's where the methodology pushes back. The run today shows CCJ at margin of safety negative 46%. DCF's intrinsic value is $56.40. The market price is around $104.05. So the verdict is sell at medium confidence. The Sentinel lens cross-checked against FMP, a third-party valuation data provider. FMP's DCF came in even more bearish at $39. Two independent valuation models, two sells. The uranium thesis is right. The entry at 104 is not. The methodology is disagreeing with me on timing, not on direction. Long cycle contract demand is real. The price already reflects it. I don't hold it. Stock 4 is NEE, NextEra Energy, Florida Power Light, plus the largest renewable developer in the United States. AI data center power deals stacked as upside on a rate-based utility that grows whether the AI booms or fades. The methodology read today is flagged at high confidence. Margin of safety is a positive 9.8%. The DCF intrinsic value is $98.55. The market price is around $89.77. Now, the methodology correction story, because it matters for trust. 2 weeks ago, in an earlier run, routed NEE as a turnaround. The DCF spit out a $7 intrinsic value against a $90 market price. The auditor lens flagged it on that run internally. I'm paraphrasing the flag. This isn't a bear case, it's a model artifact. The auditor was right, and here's the distinction that matters. The four-lens architecture didn't fail. The inputs the architecture was reading did. The standard DCF growth rate inputs don't fit a regulated utility whose debt finances rate-based assets earning a regulated return. So we added a utility sector route in front of the jury. Same four lenses on top, sector correct inputs feeding them. The methodology named the input problem, fixed the routing, and we reran. Both reads stay on the record. Not currently held. The flagged read says wait for a real discount before adding. And then stock 5, RIO, Rio Tinto. It's a copper, aluminum, and iron ore mining company. Every gigawatt of AI power needs copper, conductor, and aluminum framing. Mining capacity takes a decade to add, not a quarter. The diversified book hedges any single commodity. The methodology run shows a margin of safety of negative 62%. The DCF intrinsic value is $38.50, market around $101.25. The verdict is a sell at medium. Here's where it gets interesting. FMP's third-party DCF comes back at $121. Bullish, calling Rio undervalued by 20%. We have two independent DCFs, opposite verdicts, worth naming why FMP and the methodology aligned on CCJ a minute ago and split here on Rio. On uranium, both models use conservative commodity cycle growth assumption. On copper and aluminum, FMP treats the AI pull forward demand as permanent. The methodology doesn't. They can't both be right at these prices. The disagreement is about that one assumption, not about either model being broken. The methodology is the contrarian voice in the room. On this one, the thesis can be right. The entry at 101 can still be a bad price. I don't hold it. 5 names, 3 different ways the methodology pushed back. For NAE, the methodology disagreed with itself, fixed the routing, kept both reads on the record. For Rio, the methodology disagrees with FMP's third-party DCF on the same name with the same data. variant perception called by name. The methodology is one input. The holder's trajectory read is another. The disagreement between two valuation models is a third. Any single read taken as the whole answer is where retail investors lose money on the AI cycle. 5 stocks built to outlast the AI build out. 2 I hold long. 3 the methodology said wait. The honest version of this video doesn't tell you the answer. It shows you the disagreement and tells you where the disagreement sits. That's the read. If a methodology agrees with everything in your portfolio, it's a sales tool. If it pushes back on 3 of the 5 names you wanted to like, it might be research. That's the difference I'm trying to show you with this channel.